Okay, so on our topic number 2, starting with slide 2, we're going to talk about why we tax corporations at all, and sort of the economic rationale for that before I move into the substance of the rules. And so, obviously the spoiler alert here is that we tax corporations. That's probably not a surprise. I think for most of you are familiar enough with that idea. But the question is why we do it at all, right? And when you're thinking about why we would tax a corporation, there's a couple of different things that you need to keep in mind. The first thing that you have to keep in mind is that corporations aren't people, right? Like they may be juridical persons, but they aren't people, right? And the second point that is kind of a corollary to that is that the only a natural person can be compelled to pay tax, right? Ultimately, people don't pay tax out of the goodness of their hearts. They pay tax because they fear that the state will, use force to compel them to pay tax. You can't throw a corporation in jail. So ultimately, it's an individual somewhere down the line who is facing the threat of state action when they pay tax. So what this means ultimately for us is that because of that point, and because corporations aren't actually people, that some natural person somewhere along the line is bearing the cost of the corporate tax. And so we call that tax incidence. And there's four sets of people who could ultimately bear the incidence of corporate tax. The first is the investors. So they could bear the incidence of corporate tax in the form of reduced return on capital. Sorry, we just have somebody popping up a question here, which I think is, yeah. So Jacob, I do see that somebody is trying in the lobby, trying to be admitted. I think that same person is actually in the class right now. It looks like they're trying to join on 2 devices. So yeah, oh, there we go. They've stopped trying to connect on the other device. So I think we're good there. Carrying on, but so 4 groups of people who could bear the incidence of corporate tax. Group number 1 is the investors, who could bear the incidence of corporate tax in the form of a reduced return on their investment in the corporation. The second group is the employees of the corporation, who could bear the incidence of corporate tax in the form of reduced wages for the work that they do for the corporation. Our third group of potential individuals who could bear the incidence of corporate tax are the owners of natural resources. So people who own land, or generally, the population of the country as a whole, if we're talking about like an extractive industry, they could bear it in the form of reduced rents for natural resources. And your final group of individuals are customers of the corporations who may bear the cost of corporate tax in the form of higher prices. So, and this is where a lot of the discourse about corporate tax in academic circles happens, is about incidence. And Canada, I think, we're a little bit different than the US, for example, where there's a very different discussion on incidence. We're a small capital importing economy. And so what the economic literature suggests is that in Canada, it would be either natural resource owners or employees who actually bear the incidence of corporate tax. And the rationale for this is that foreign investors who make up a large portion of Canada's capital base, or tax exempt persons who are Canadian but could invest elsewhere, which again is a very large portion of our capital base, would simply invest elsewhere if that was what it took to generate a better rate of return after tax. And so there's potentially not a lot of room to raise tax or to cause them to bear the incidence of tax there. And similarly, because it is an open economy, and Canadian customers have choices about where they're going to shop and who they're going to buy from, there's limited ability for corporations to recoup the incidence of corporate tax through higher prices. Those are generally set by the market, subject to some peculiarities that we have in Canada, that would cause prices to be higher, including currency conversions and tariffs and transportation, et cetera, and licensing, et cetera. So those kinds of things. But generally, prices are set by global markets, and there's not a lot of room for raising or lowering them based on tax rates. So, and because of these two things as well, this is why you tend to not see corporate tax increases raise quite as much revenue as people would expect that they would, is because in large part, we may be trying to cause taxes to be borne by mobile capital, and mobile capital responds by investing elsewhere. That being said, I don't think this is universally the case. I think certainly what I would tell you is from experience and practice is that the owners of private corporations certainly act like they bear the incidence of corporate tax. And so probably much of what we're thinking about from the academic literature is really a reflection on how large taxpayers, public corporations, non-resident investors, et cetera, respond to corporate tax, and it's probably not a great indicator of how owner-managed businesses respond to tax incidents. So even if we were to assume that corporate taxes are economically efficient, which they are, they're generally the most economically inefficient revenue raiser of our large taxes, right? The ones that generate most of the federal and provincial government revenues are personal income tax, corporate income tax, and GST. Corporate income tax is certainly the least efficient of those three taxes, but we still do it, and there's often good reasons to do things that are economically inefficient. The same economic literature that would say corporate tax is highly inefficient would say that a minimum wage is highly inefficient, and we do that anyway, and there's very good and compelling reasons why we have a minimum wage and why we can tell libertarians to pound sand when they say that we shouldn't do that. So the question then becomes, well, why do we do this, even if we recognize that it's potentially economically inefficient? And the literature, such as it is, suggests that there's three reasons why we would impose corporate tax, even if it's not the most efficient thing that we could do. And the first is that corporations enjoy limited liability by statute. So that's a benefit conferred on corporations by the state. And therefore, it's rational that corporations should have to pay tax as a kind of a trade-off for that benefit of limited liability, which certainly with large corporations allows them to exist at all. You wouldn't have the equivalent of a public corporation if you didn't have limited liability. That rationale I find to be not compelling. I think when we go back to our incidents, our first point about incidents, that individuals bear the cost of corporate tax one way or another. It's really individuals who also benefit from limited liability. It's not the corporations themselves. Corporations aren't people. They don't have brains. They don't care about limited liability. So it seems that imposing tax at an entity level on a corporation because the shareholders enjoy limited liability is not a very compelling reason to impose a corporate tax. The second main reason that you see in the economic literature is this idea that a corporate tax, if properly designed, can be a tax on pure economic rents, which are basically the profits of the corporation in excess of a risk-free return on capital. And that, if you impose a tax in those situations and on those terms, then it's really a way of exporting Canadian tax to non-resident investors in Canada. Again, that is an interesting view, and I think certainly just in some stuff I've read in the last couple months, it seems that view is catching on, I think, more, and is starting to become more predominant. And there's, I think, at least certainly within Canadian academic circles, a push to make corporate tax more of an actual tax on rents, as opposed to the way it's currently set up, where it really taxes things that would still be a risk-free return to capital, although with enhanced CCA deductions, et cetera, it's getting closer to an actual tax on rents as opposed to a tax on all forms of income. So that rationale is interesting. Again, it's not necessarily compelling in the sense that non-residents could still shop for better after-tax returns elsewhere, but theoretically, at least, the compulsion to do so would be lessened if you were only taxing rents and you were not taxing the basic return on capital. And so the third rationale then, which is the one that, as we're going to see, is really reflected in the design of the corporate income tax, is that the corporate income tax functions as a withholding tax. And so there's two reasons why we'd want to impose withholding tax on corporations. The first is that it can be very hard to track the ownership of shares of corporations. Certainly this was true when the corporate income tax first came into existence. If you had a public corporation, it would be virtually impossible to know at any point in time who the shareholders of that corporation were. Now with computer records, that's less of a concern. Certainly the public corporation and the share transfer agents, et cetera, will know or could identify at any point in time who is or is not a shareholder of the corporation. So somewhat less of a concern. The second thing, though, that we're going to see over the next couple weeks is that when you have shareholders of a corporation who are not taxed on a flow-through basis, like a partnership, so when they're taxed only as the corporation makes distributions to them, there is a deferral there. And if we didn't tax corporations at all, so we didn't have this withholding function for the corporate tax, those shareholders could defer tax indefinitely as long as they never extracted funds from the corporation. So having the corporate tax at least allows us to get something out of the shareholders right now. Again, assuming that the shareholders will have some incidence. So that's the kind of rationale number three. As I said, that's historically been the rationale for the corporate tax in Canada. And it, as you're about to see, it really does motivate the design choices for the Canadian corporate tax system. So if we flip to slide 3, and this is following on the first page of handout number 4 at point 4 on handout number 4. There are 6 ways that we could tax corporations, right? The first is that we would only tax the shareholders when they receive dividends or sell shares with no entity level tax. So if we did this, there would just be no such thing as the corporate tax. Shareholders would be taxed on dividends and on capital. They would be taxed on dividends when they receive dividends. They'd be taxed on capital gains when they dispose of shares. So if we did this, there would be a total deferral of undistributed corporate earnings, unless shares are bought and sold regularly or unless dividends are paid. And if we did this, we would have to tax capital gains at ordinary income rates, right? There'd be no basis for a 50% inclusion anymore. We'd have to tax corporations we'd have to tax capital gains at full income rates. This is obviously not practical. It just wouldn't be, right? If we didn't have an entity level corporate tax, that would just create too much of a revenue hole and too much of a deferral opportunity for the government. And there's a reason nobody does this as a practical matter, and that's probably why. So option 2 is that we would tax corporations like a partnership. And so this was something that we talked about how we would tax partnerships last week. This was something that the Carter Commission thought about doing in the 1960s, which was the last time we had a really fundamental overhaul of the Canadian tax system. And the Carter Commission at that point decided it would be too complicated and administratively difficult to do. However, again, with computerized records, we probably could now just do entity level tax, or not entity level tax, do shareholder level tax for corporations on income as it's earned. Again, the income trusts, which we talked a little bit about last week, income trusts and SIFT partnerships, their existence, really proved that you could in fact do this with 2006 to 2009 technology. So certainly with 2020 technology, it would be completely feasible to tax on a fully distributed basis. Certainly, even outside of Canada, there's large investment funds that have thousands of investors who have to tax on a fully distributed basis. So again, no reason why we couldn't do this. That being said, if we did move to tax on this basis, we'd still have to collect tax from non-resident persons. And so we'd still have withholding taxes on allocations of income by our corporation or distributions by our corporation that are going to look a lot like the current dividend withholding tax. So, something to consider, but not necessarily the option. And option number 3, what we would do is we wouldn't have a corporate level tax, but instead what we would do is we would tax dividends when they're received by the shareholders. And at the end of every year, shareholders would have to include in their income the appreciation of the shares. So this would be something like the Haig-Simons definition of income, of which you may have talked about in baby tax. And this is basically like mark-to-market accounting for large corporations. For those of you who have an accounting background, it would be basically the same concept. If we thought that retained earnings of a corporation translated to share value in some way, then this would be a feasible thing that you could do. Obviously, there's valuation concerns, and certainly if those of you who've been following the news about discussions about wealth taxes and how valuation concerns arise there, you'd have similar valuation concerns here, especially with private corporations. But again, this is one of those things that's certainly more feasible in 2020 than it would have been in 1960, and so it's not necessarily something that you can reject out of hand. Option 4. What we would do in option 4 is we would not tax shareholders on either dividends or capital gains on the disposition of shares. What we would do instead is we would just tax the corporation at the highest marginal rate applicable to individuals. So as a result, it would be the same as if we were taxing people on a fully distributed basis, but we would just be taking this idea of a corporate tax as withholding tax to its logical extreme, and would be trying to collect tax at the individual rates from the corporation. This is not feasible in an open capital importing economy, right? We could not do something like this. There's just no way. Corporate tax rates would be very, very high. What we'll talk about is, in Alberta, as we're going to see, we have an effective corporate tax rate of about 23%. For large corporations, if we did this, it would go up to about 48%, which would be certainly the highest corporate tax rate in the OECD by a lot, and would just render Canada completely non-competitive for investment by outsiders. So that is not happening, right? Option 4 is a no-go. Option 5 is what we call a classical double taxation system. So in option number 5, what we're doing is we're taking this idea of the corporation as a separate legal person to its logical extreme, and we're going to impose tax on the corporation at some rate that we pick, and we're going to then impose tax on the shareholders when they receive a dividend from the corporation or when they dispose of their shares in the corporation, again at some rate that we're going to arbitrarily pick. And there's going to be no relation between the corporate income tax rate and the personal income tax rate. And yeah, there's going to be some element of double taxation there, but tough, right? That's the classical double tax system. That's what the Americans do. Interestingly enough, they have just a flat corporate rate at what it's now 21% plus state tax. And then individuals are taxed on dividends and capital gains at a flat rate, well, not quite flat, but for the most part flat, topping out at 20%, plus state taxes, plus Obamacare tax. So that's what the Americans do. It's a workable system. It's conceptually, as we're going to see when we get into how we actually tax distributions in Canada, it's a much simpler system than the one that we use, which is, you almost never get to say that about the US tax system, that it's simpler than something that we do in Canada, but that is actually an instance where it is simpler. There is a bit of a push, again, in current academic tax discourse, there is a push that maybe Canada should go back to a classical double tax system like the US does, because our system, some would say, is a little bit broken and has become a little bit too cumbersome under the weight of the assumptions on which it's based. And then finally, option 6. This is what we actually do in Canada, is option number 6, or we do some iteration of option number 6. And again, we do option number 6 because it's consistent with our idea that the Canadian corporate income tax is a withholding tax. And so the way this works is we tax corporations at a fixed rate that is much lower than the individual rate. Again, so like we said in Alberta, it's 23 versus 48%. We tax shareholders on distributions. So when they receive a dividend from the corporation, they're subject to tax. So at the start, this sounds like a classical double tax system. But what we do is we reduce the rate of tax that the shareholder pays on the dividend by an amount that represents the corporate tax paid by the corporation on the pre-tax amount of the distribution. And so the idea is that you should end up with a combined corporate shareholder rate that approximates the top marginal rate for individuals. It's never exact, as we're going to see, because it's all just based on a giant pile of assumptions. But the perfect in a perfect world where the provinces impose tax at a set rate and they all impose tax at that same rate, we would get pretty close to having having full integration. We actually don't integrate capital gains, which interestingly creates its own it creates its own problems, so much so that nobody cares that we don't integrate capital gains, because the non-integration produces a better result for people than integration would. So with that, we can flip to slide 4. And so this is now we're going to start talking about, with our 25-minute divergence into tax policy aside, we can now go back to mechanics and how we actually impose corporate tax and how things actually work. So the first step in implementing our policy choice for corporate tax, which is option number 6, is that we have to make the act apply to corporations. And the way that we do this is by specifying that a taxpayer is a person, and by specifying further that a corporation is a person. So both of these definitions are in subsection 248(1), as noted on the slide. Because the corporation is a person and a taxpayer, any rule in the Act that does not provide that its application is limited only to a specific subset of taxpayers that excludes corporations will include corporations. So everything that you learned about income tax, in your baby tax course, like sections 2, 3, 9, 13, 38, 39, 40, etc., these all apply to corporations equally and on basically the exact same terms as if they would apply to individuals. However, as we're going to see, the rate of tax that's applicable to corporations on income from these sources is treated different. There's a different tax rate and a different way to get to that tax rate than there would be for individuals. The other difference that we're going to see between corporations and individuals is that corporations get to pick their taxation years, whereas individuals do not. Individuals are basically, for all intents and purposes, stuck with the calendar year taxation year. Corporations are, for the most part, not. So paragraph 249(1)(a) provides that a corporation's fiscal period is its taxation year, and subsection 249.1 sub 1 defines a fiscal period as the corporation's accounting period, provided that that fiscal period does not exceed 53 weeks. There are some instances where section 249 and other rules will deem a taxation year to end at a different time than would otherwise be the case just under accounting conventions. And so we'll talk about some of those as we move through the course, but just be aware that there are deemed year ends in certain circumstances, like on a loss restriction event slash acquisition of control, on a change in status from a CCPC to a non-CCPC, et cetera. You'll understand what that last set of terms means in a little bit. But some changes in year ends. There are also some types of corporations can be forced onto a calendar year end. So for example, like a professional corporation generally will get forced onto a calendar year taxation year. And as well, we talked about section 34.2 last week, which is the partnership anti-deferral rule. That will often have the effect of forcing corporations to adopt the partnership's year end if it's not convenient for the partnership to change its year end. So things like that to keep in mind. But in the abstract, corporations have free reign to set their taxation year however they please. Moving on to slide 5. This is kind of the very simple seeming questions that have some very interesting actual implications. And so, the questions are sort of discussed in the handouts, and it's a very similar answer to both questions in terms of what the implication of the corporation being a separate taxpayer are for both the corporation and the shareholder. For the corporation, the implication of being a separate person and separate taxpayer is that the corporation is going to pay tax at the statutory rate, regardless of whether or how its shareholder would be taxed. So, even if the shareholder of the corporation would not be taxed, unless the corporation is itself exempt from tax on some basis, for example, because it's a nonprofit, or it's it's owned by a municipality, or it's a crown corporation, or it's a charity, or something like that, the corporation is subject to tax at the fixed rate. And so this is a potentially a big deal for low-income taxpayers. For example, if you're if we're supposing that we have a corporation that's carrying on business in Alberta, resident in Canada, carrying on business in Alberta, would be taxed at either 11% or 23%, depending on whether it's a CCPC and whether it qualifies for the small business deduction or not. If the shareholder's effective rate of tax, because the shareholder is a low-income person, is less than 11% or 23%, as the case may be, there's just an absolute loss there, right? Like that's an absolute loss to taxation. Where had the individual carried on the business directly, there would have been tax at a lower rate or potentially no tax at all. And that's a fairly important implication when you're dealing with what we'll call air quotes like regular people, as opposed to super high income people, where they're going to be taxed at a higher rate than 21% no matter what, or 23% no matter what. The other, and again, the other place where it's a very big deal is if the shareholder would be tax exempt, but the corporation would not. So, for example, many corporations that would be controlled by, for example, Indian bands will be subject to tax, or corporations might be controlled by status Indians individually who would not be subject to tax if their income was earned on a reserve, but the corporation would be subject to tax in any event, again, unless it's exempt from tax on some statutory basis. So for these people, having a corporation that's a separate taxpayer is, just profoundly bad. And so again, there's going to be a real economic motivation to avoid having a corporation for taxpayers who are tax exempt. For an individual, the implication of the corporation being a separate taxpayer is that the corporation's losses are not available to the shareholder to deduct. Even and this is true even if the losses of the corporation are being funded by contributions from the shareholder. It may be that the shareholder will, at some point, if the corporation's business fails, be entitled to a capital loss on their debt owing from the corporation or on their shares of the corporation. In some circumstances, it may be possible that that capital loss gets classified as an allowable business investment loss, or ABLE, in which case it would be deductible against income. But by and large, there's no flow through of losses from a corporation to a shareholder. So this again is an important point to keep in mind if you're dealing with a risky venture that could produce losses, and the shareholder has income from other sources. That while you want limited liability, to make sure that the shareholder isn't going to be stuck with debts or claims against the business being personally liable for those debts or claims. At the same time, they're not going to get any tax relief, or they're going to get limited tax relief in the form of a capital loss because they're funding that speculative venture. So in that case, something like a limited partnership might make a great deal of sense. So moving on with mechanics, if we flip to slide 6, we have in the handout there, the handouts, handout number 4 discusses the different types of corporations. There are many, and the reason why we do this is we need to have different sets of rules apply to some corporations, but not all corporations. And having different types of corporations is much easier than having to add more conditions of application to the various rules. As we're going to see, many of the rules that we have to tax corporations are already mind-numbingly complicated. And if we started to add, conditions of application in order to distinguish good corporations from bad corporations in those rules themselves, they would just become far too cumbersome. So this is why we have, different types of corporations. So at least people who are, practicing corporate tax, whether as a lawyer or an accountant, can know what those types of corporations are just offhand and can apply or not apply the rules accordingly. So as I've indicated on the slide, what type of corporation you're dealing with can have implications on the tax rate applicable to the corporation's business income, and it can impact whether a special anti-deferral regime applies to the corporation's income from a source that is property. It will also impact whether some tax expenditures like refundable scientific scientific research and experimental development tax credits, which everybody just calls SR&ED, whether those refundable SR&ED credits are available to the corporation. And finally, most of our tax-free rollovers that we're going to talk about in this course, where people can transfer property to or from a corporation tax-free, most of those only apply to certain types of corporations for the reason that we want to make tax avoidance at least a little bit challenging for people. Moving on to slide 7, we have 6 different types of corporations that are listed on the slide. Leaving aside the non-public, non-private corporation for a moment, we can go through the other 5 that are on this list. So the first is the public corporation. I think we're all familiar with this, like the RBC, TD Bank, etc. Public corporation. The term public corporation is actually a defined term for income tax purposes. It's in subsection 89(1) of the Act. And it's defined as a Canadian resident corporation with a class of shares that is listed on a designated stock exchange. So effectively, in Canada, that's the TSX exchange, the TSX Venture, and there's like the CanX exchange are basically the designated exchanges in Canada, as well as the New York Stock Exchange, Euronext, etc. The Nikkei. There's a bunch of other exchanges as well worldwide that are listed as well. Alternatively, you can be a public corporation if you have a Canadian resident corporation that meets prescribed conditions in terms of in terms of being widely held and has elected to be a public corporation. That's provided for, again, in the definition of public corporation, subsection 89(1) and in regulation 4803. I'm not going to propose that we think about regulation 4803 in this course. So generally speaking, if you want to just as a shorthand for a public corporation, think of a Canadian resident corporation that has a class of shares listed on a designated stock exchange. That's going to be good enough for our purposes. Next, we have a private corporation. Again, this is a defined term, and that's in subsection 89(1). And a private corporation is a resident corporation that is not a public corporation and is not controlled by a public corporation, a crown corporation, or any combination of public corporations and crown corporations. There's also a deeming rule that provides that a corporation incorporated after 1971 and that was a private corporation on incorporation was never not a private corporation. Again, we can mostly just ignore that. So for our purposes, again, if the corporation is a resident Canadian corporation, not a public corporation, not controlled by public corporations or crown corporations, we can treat it as a private corporation. Next, we have the definition of Canadian corporation in subsection 89.1. And this is very simply defined for most corporations as being a corporation incorporated in Canada. If it's incorporated in Canada, generally speaking, it's a Canadian corporation. There are a couple special rules. First, if a corporation was incorporated before June 18th, 1971, it can be a Canadian corporation even if it was not incorporated in Canada, provided that it was resident in Canada from, at all times from June 18th, 1971 to the present date. I don't think you are ever going to see this in practice, just because there are so few pre-1971 corporations that are left in circulation. And even pre-1971, I don't think it was especially common to see a corporation incorporated in a foreign jurisdiction and resident in Canada because its mind and management were located in Canada. That does not strike me as being something that would have been at all commonly done. And especially given that with our tax treaties, it seems unlikely the corporation would have been resident in Canada anyway. So, we can effectively assume that rule will never apply. Also, a corporation that results from a plan of arrangement or similar amalgamation or merger that would be incorporated in Canada under the terms of the plan of arrangement is deemed not to be a Canadian corporation if the plan of arrangement was governed by the law. Excuse me. Oh my God. If the plan of arrangement was governed by the laws of a country other than Canada, or if one of the predecessor corporations was not a Canadian corporation. So basically, if you have a plan of arrangement that results in the merger of a Canadian corporation and a foreign corporation, regardless of whether or not the plan of arrangement deems the successor corporation to be incorporated in Canada and the court so orders that it's incorporated in Canada, this deeming rule will deem the corporation to not be a Canadian corporation in those circumstances because of the non-Canadian predecessor. This is something, if you are going to practice law in Edmonton, I do not think you will ever see this in real life. Perhaps if you practiced law in Toronto or Calgary or Vancouver, you might. But even then, I don't think that's common. Generally speaking, when we're going to have a cross-border transaction, the way it's going to be affected, if it's an outbound transaction, is that the Canadian parent is going to form an amalgamation sub in the foreign jurisdiction and amalgamate that with the target, or similarly, the foreign parent on an inbound transaction will form a Canadian merger sub that will acquire and amalgamate with the target corporation in Canada. So I don't think you're ever going to see that in real life, but you will 100% not see that in real life if you work in Edmonton. So, dampen your expectations for what practice will look like there. Next, we have the taxable Canadian corporation. Again, this is defined in subsection 89.1, and it's a Canadian corporation. So again, a corporation incorporated in Canada for our purposes, that is not exempt from Part 1 tax. So this is, there was at one point a carve out for farm insurers that's been repealed, but basically a taxable Canadian corporation now is just a Canadian corporation not exempt from Part 1 tax. Taxable Canadian corporation is actually a very important definition for our purposes, simply because almost all the fund rules require that a corporation be a taxable Canadian corporation in order to do anything on a tax deferred basis. Some exceptions, but for the most part, it has to be a taxable Canadian corporation. And then finally, the last one we have on the slide, well, the last one we're going to talk about on this slide anyway, is the Canadian-controlled private corporation. And taking a break from everywhere else, this is actually defined in subsection 125.7 rather than in subsection 89.1. And it's actually defined in a negative sense. So it is the CCPC has to be a Canadian corporation that is not controlled by a public corporation, a non-resident, a combination of public corporations or non-residents. It's not listed. No shares of any class are listed on an exchange. And there's also hypothetical shareholder rules, so that even if the corporation wasn't controlled by any ascertainable group of non-residents or public corporations, this hypothetical shareholder rule basically requires you to suppose that there was an imaginary shareholder who doesn't actually exist, and this imaginary shareholder owned all of the shares that were owned by non-residents or public corporations, and then saying, okay, well, if that hypothetical shareholder actually did own all those shares, would that person control the corporation? And if so, then it's not a CCPC. So as well, a corporation that would be a CCPC under the definition can elect to not be a CCPC for certain purposes. Not any of the ones where you usually want to not be a CCPC, but for some purposes you can elect out of the definition as a result of paragraph D of the CCPC definition. What we're going to see is being a CCPC is also very important for two of the main corporate tax rules that we're going to talk about in this course. The first of those rules being the small business deduction. Being a CCPC is critical there. And the second is that for the purpose of taxing investment income, how corporate investment income gets taxed also turns on whether the corporation is a CCPC. For that purpose, the paragraph D election doesn't apply. So just whether you are or not a CCPC absent the election really matters in determining whether the corporation is subject to tax at a higher rate on its investment income. So there actually is a little bit of tension there, because sometimes you want to be a CCPC to get the lower rate on business income, and other times you really don't want to be a CCPC in order to get a larger deferral on investment income. So whether you want to be a CCPC or not can be highly context dependent. So with that, we can flip to slide 8. And slide 8 is asking about non-public, non-private corporations. This is actually a question from the handout. And the first question from the handout is, when is a corporation neither a public corporation nor a private corporation? If anybody wants to take a stab at that, please jump in. Pam, go ahead.
I'm assuming a crown corporation is not a private or public?
Yeah, I think that's right. I think that's right. If you certainly a corporation controlled by a crown corporation would not be a certainly a corporation controlled by a crown corporation would not be a private corporation. And I think I agree with you that a crown corporation would not be a public corporation or a private corporation either. So yeah, but that's basically the answer is that Pam has given is that a corporation is not a public. Where this will happen is where you have a corporation that isn't a public corporation because its shares aren't listed on an exchange, but it is controlled by a public corporation, or it is controlled by a crown corporation. So in those situations, the corporation will not be a public corporation, but it also will not be a private corporation. So as an example of this, any wholly owned subsidiary of a public corporation would not be it would be any wholly owned subsidiary of a public corporation would be a corporation that is neither a public corporation nor a private corporation. So again, using RBC as our example, Royal Trust Corporation is a corporation that is neither a public corporation nor a private corporation. The second question, which is a little, I'm not going to, I think, bother throwing that one out because it's fairly basic. It's just asking what taxation rules apply to that corporation. And so the answer there is pretty straightforward. It's the same tax rules that apply to any other corporation, apply to a corporation that is neither a private corporation nor a public corporation, except for any rule that specifically applies only to private corporations or that specifically applies only to public corporations. So, for example, the non-private, non-public corporation would still be, in most instances, a taxable Canadian corporation. It would still be a Canadian corporation in both cases, so long as it's incorporated in Canada and subject to tax on all of its income. So with that, I think we're getting reasonably close to a natural break time. So why don't we pause and just, does anybody have any questions on what we've covered for the last 50 minutes or so? Thomas.
It's actually not directly related to the question, but I'm wondering whether you entertain questions during your break.
Whether you can post questions during the break, yeah, absolutely. Go nuts, either in chat or on email. It's great.
Okay. Yeah, I will wait for the break.
Okay. I saw somebody else, David.
So for that last one, you said that any other rules apply. Just to clarify, does that mean that when you consolidate the subsidiaries into the parent corporation, those rules apply, or is it a different set of rules for the subsidiary than it would be for the parent?
It would be a different. Let's back up. First of all, what we're going to see is that for Canadian tax purposes, we don't consolidate subsidiaries into parents, unlike in the US and unlike for IFRS/GAAP purposes. There's no consolidation, so entities are taxed on a standalone basis. But yes, the result is that if you had a corporation that is neither a public corporation nor a private corporation, because it's an unlisted corporation that's controlled by a public corporation, then potentially yes, the subsidiary could be subject to tax under different rules than apply to the publicly traded parent, because any rules that specifically apply to a public corporation only will not apply to the wholly owned subsidiary in that example. Offhand, there's not going to be many rules where that actually is the case. Like in real life, there's not going to be a lot of that, simply because most rules will treat corporations controlled by a public corporation in substantially the same way that they treat the public corporation if they're part of the affiliated group. But yeah, absolutely, there could potentially be different treatment between the parent and the sub in those circumstances.
Okay, thank you.
Welcome. Anybody else? All right. Seeing none, I'm going to stop the recording, and we will take